Hey everyone, Greg Towner here with Parallel Portfolios, and it's time for our latest 5 charts in 5 minutes. So let's get right into it for February. Well, you all probably know that we like to start with the 3-year look at the S&P 500 chart. You may recall last month when we spoke, we were pointing out that we were yet again stuck at this downtrend line. We even drew a line at that time. Well, we've now broken above that. We thought there were some things happening under the surface that this might finally be the time that we'd move above, and we did. But what we want to focus on this time, and it's a little hard to see here, but this orange line is actually the 50-day moving average. And it's now just ever so slightly moved above this lighter blue line, which is the 200-day moving average. And this is important, and we're going to keep monitoring it because of our next chart. When that orange line, the 50-day, is up above the 200, it really signifies a positive uptrend. And returns in that scenario, historically, going all the way back to the 1950s, has been about 15 to 16% annualized returns. Really, really strong. When the opposite is the case, when the 50-day is below the 200, noting a potential downtrend, stock returns are only about 4%. So, of course, these are averages. We don't know what exactly is going to happen this time, but the fact that we are starting, at least potentially, a new uptrend is a real positive based on the data and based on some other things that we're looking at as well. Well, moving away from the market and into the economy, what was the big number last week? Huge, huge jobs number. The monthly number that came out, they were expecting about less than 200,000 new jobs. We ended up with more than 500,000 new jobs. Now, there might be some odd things happening in there. The weather was better than normal, some other factors. But the bottom line is the job market is staying incredibly strong. The unemployment rate is down to 3.4%. That's the lowest since 1969. I mean, it's just really moving strongly. If we look at another chart here, this is actually looking at the number of reports in a row, job reports in a row, that were better than expectations. So remember, the market doesn't just like good or bad. It wants to know were things better than expected, worse than expected, and so forth. So now 10 straight reports have been better in the jobs market than expected. And that's by far the most going back more than 2 decades now. So a lot of strength there. But there's a double-edged sword with this, right? So we've talked about this before, but let's think about it. Jobs market is great. Everybody has jobs. That's fantastic for the economy and for those individuals, of course. What does the US consumer do when they have a job? We know historically they spend. The consumer loves to spend money. Well, again, that's good for the economy, but what does it risk? It risks inflation staying stickier, and the Fed is worried about that. The Fed is concerned that the strong jobs market means people are going to spend. Inflation will stay sticky for a while, and so the Fed may, raise rates more. They may keep them higher longer. So that is kind of a risk of a strong jobs market, ironically enough. Well, we can't go away without talking about inflation. So, we've mentioned in the last couple of reports about how inflation obviously has been coming down in the government numbers. But one area that we haven't seen happen much is in the shelter, as they call it, usually the rental prices of apartments and multifamily homes. Well, that still hasn't reflected too much in the government data, but some of the other surveys that we're looking at are showing a lot of upcoming weakness in terms of pricing. This looks at apartments. When you're down here, it's kind of a looser market, more availability, lower prices. So we're moving in the right direction there. That will hopefully get into the government CPI data shortly, particularly since, to take the other side of it here, we did just finally see a little uptick in used car prices. They've been coming down for months. So that could be a little bit of an offset from the shelter. We don't think inflation is going down in a straight line. I mean, it's been coming down nicely for a number of months now. That won't always be the case. There'll be some periods where it kind of works against us a little bit. The Fed recognizes that. That's why they're keeping rates fairly high and probably going to raise them a little bit more. So, in general, things are moving in the right direction, but not going to be a straight line by any stretch. In closing, stocks are definitely moving above that resistance level. Doesn't mean they're for certain going to stay above it, but they're above it now. We think that's a real positive for the market. But we will say our base case remains the fact that stocks look like they're going to be trading in a wide trading range for a while. Investors have gotten used to stocks going up and up and up, or there's a big sell off. We think there's going to be a wide trading range, and we're probably roughly in the middle of that right now. But investors should stay open minded to potential different outcomes. We hope that the Fed will stay open minded as well, because the strong job market is testing them for sure. We hope that they don't go too far too fast. We'd like to see them kind of pause and see how the actions that they've taken work in through the economy and through the markets. But they are the big question mark that we will be keeping an eye on and talking to you about more in the future. So thank you for joining us, and we'll get back to you next month.